Now, but my next guest remains bullish on that trade, saying productivity gains will lead growth stocks higher this year. Let's bring in Nancy Tengler. She's the CEO and Chief Investment Officer at Laffer Tengler Investments. Nancy, great to see you. Do you want to start just responding to, I don't know if you caught a portion of that interview with Mike, and he's saying core PCE 3.1%, maybe there's no more rate cuts coming.
Yeah, I don't see that, Kelly. And by the way, I'm not saying we should have rate cuts or not, but I think that in addition to productivity, what you've seen is wage gains that are now above inflation. Productivity is improving to the extent that it was greater than GDP in the third quarter at 4.9%. Now, it's a notoriously volatile metric, but the trend line is important, and it looks like we're in an uptrend for productivity. We've been pounding the table on this one for about 3 years. It is analogous to the 90s. I think we can survive with higher rates and a little bit higher inflation, but that is not the way that the rest of the world views this. And I think the Fed will probably cave, maybe not at the January meeting, but certainly as we go through the year. And it's important to note, this hand-wringing over jobs is a little bit troubling to me, because you can have a static job market. And that's what we've got. We've got kind of a tepid job market. Last time we saw that, where we had a sector that was growing, was energy, oil and gas extraction. And we went from being a net importer to a net exporter without adding jobs to the sector due to CapEx spend and technological advancements. So I think that's what we have to kind of look at. And then the fact that new business applications have skyrocketed above levels we've seen, except just below what we saw briefly in COVID. So if you're a software coder and you're starting a new business, that's a pretty high productive, high pay business. So I think that's where we have to focus, instead of just looking at these numbers that have been revised so dramatically. And by that, I mean the jobs numbers.
It's a great point. And I love what Mike said, which is, 0 to 50,000 a month might be the new normal, and maybe that's fine. But I just want to take a step back, because the larger story for the rally the past couple of years has been, this is more like the 70s and 80s, right? Once inflation's coming down, once rates are coming down, once the Fed's cutting because the biggest problem was inflation and we dealt with that, it's really, really bullish. But I listened to Mike Feroli and I watched the 10-year, and I think to myself, the biggest risk then to this rally is really one where all of a sudden those rate cuts are not continuing. So what percentage odds would you assign that scenario? Because that's probably a bigger concern for growth stocks. That's probably a bigger concern for the markets if the Fed has to stop all of this and turn its attention back to kind of the vanquishing inflation phase.
Yeah, I just don't see it, Kelly. I mean, I would assign a probability of less than 20%, because you are seeing housing come in, energy prices are down, the tariffs are going to lap in a couple of months, and that will, it's still, the cost increases are still there ostensibly, but you aren't going to see additions to inflation and core goods from tariffs. It's now in the numbers. So I don't see it, and I think this is an economy that is in transition, and that we've seen that many times before, most recently, in my view, in the 90s. And during that period, some of the norms, some of the things that you count on don't necessarily come to fruition. And so I don't see the Fed sitting on their hands for the whole year. However, in the 90s, we did get one hike, and it didn't derail the stock market rally.
True.
So, if that needs to happen, I'm okay with that. I think the Fed is becoming less and less important to the argument as earnings growth continues. But as you saw in my notes, our mutual friend Brian Reynolds is concerned because corporate tax receipts in the fourth quarter were lower than expected, and that's an indication of earnings. So we're watching that pretty closely.
Yeah, we did just check in with him on that the other day. So looking back at your ideas, some of them in here, kind of absolutely fit the narrative that you're crafting, which is Amazon and Google. There's others in here as well, which are AMD and Tesla and CrowdStrike. Would there then be a case, Nancy, for kind of just sitting on your hands, broad ownership of stocks, you don't worry about it, and Symbiotic is up there as well, which is one we hear a lot less about, or is there anything more tactical that you would do right now?
Well, I mean, we always use volatility as our friend because we're long-term investors. We're not trading for tomorrow. We're trading for the next 3 to 5 years. And so during the tariff tantrum, we added to Tesla at 240, Palantir at 88, NVIDIA at 108. So that's how you make money over the long term. Yeah, those names have come in some, but they're well above the levels that we stepped in. So you've got to have courage. You got to know what you want to buy, and then you've got to be able to step in and do it. And then, remain vigilant and watch management, watch earnings growth, and watch revenue growth, because that's what really matters.
All right. You're not concerned about the banks today? Anything like that? Anything from earnings season thus far?
I'm concerned.
You are?
I'm always concerned, Kelly.
You know what I mean?